The Commodity Markets Bubble, Money Manager Capitalism and the Financialization of Commodities by L. Randall Wray. Introduction. We do live in interesting times. Over the past decade, we've seen what are arguably the biggest equity, housing, and commodities booms in U.S. history. Could it be a coincidence? I've previously argued that the U.S. real estate bubble was not an isolated event that resulted from spontaneous mass dilution or excessive monetary ease, and indeed that the financial crisis spawned by problems in subprime mortgages would spread far beyond housing debt. Following Hyman P. Minsky, I blamed money manager capitalism, the current economic system that dominates the global economy, characterized by highly leveraged funds seeking maximum returns in an environment that systemically underprices risk. In this paper, I will argue that the commodities boom is no different. Soaring energy and commodity prices are in the direct product of a boom-bust cycle that is getting progressively more damaging to the economy. With little regulation or supervision of financial institutions, money managers have concocted increasingly esoteric and complex instruments and practices that spread as quickly as a deadly virus in a sci-fi flick. Contrary to what is taught in economics and business courses, markets generate perverse incentives for excess risk, punishing those who are reluctant to join the bandwagon with relatively low returns. Those who do play along are rewarded because highly leveraged funding drives up prices for the underlying assets, whether they are .com stocks or Las Vegas homes, until the inevitable collapse. But memories are short, dumb money is ample, and bailouts are frequent. Since each bust wipes out only a portion of the managed money, a new boom inevitably rises, like Phoenix out of the ashes. Commodities are simply its latest reincarnation. To make matters worse, the consequence of each boom and bust is more severe than the previous one. It is fairly easy to look back with some amusement at the fate of Pets.com. Do we really care that a handful of geeky internet gazillionaires made and lost fortunes based on business models fabricated to burn through foolish people's money? We might even be able to overlook the recession that followed the NASDAQ crash in April 2000. However, it is not so easy to ignore the real suffering of homeowners across the nation as they face foreclosure and eviction. The financialization of America's residential real estate, which turned homes over to a giant international casino, will undoubtedly impose large economic and social costs for many years to come. Worse still is the financialization of food and energy. Many Americans are being forced to cut back on driving, heating their homes, or even buying groceries at the supermarket. The world's poor, meanwhile, are starving, as managed money puts the price of food out of reach. To be sure, it is very difficult to determine how much fault should be placed in the laps of money managers, because there are a number of forces coming together in a perfect storm to drive up commodity prices. Still, there is adequate evidence that financialization is a big part of the problem, and there is sufficient cause for policymakers to intervene with sensible constraints and oversight to reduce the influence of managed money in these markets. Further, there is every reason to believe that this boom is going to crash in a particularly ugly way, so it is not too early to begin formulating the proper policy response to the coming collapse. Finally, if history is any guide, as former Federal Reserve Chairman Alan Greenspan was fond of putting it, we can expect the managed money that survives the coming crash to search for yet another asset class. Hence, policy ought to be reformulated to try to prevent the next speculative boom. We will begin with an analysis of three explanations for the explosion of commodity prices in recent years. While these are sometimes presented as rivals, I will argue that simply because one explanation is valid, the others are not necessarily incorrect. Indeed, there are synergies at work, such that the forces driving prices higher reinforce one another. We will first look at the typical explanation provided by economists. It is all a simple matter of supply and demand. Supplies are naturally constrained, while demand has been climbing rapidly. A nod is usually given in the direction of the booming economies of India and China, along with the warning that any attempt to regulate or supervise financial and commodity markets will just make things worse. All that can be done is to encourage the supply side by, for example, opening up the Arctic to more resource exploitation. The market will then efficiently allocate resources among competing wants. The second story involves market manipulation by commodity producers and traders. Indeed, in recent weeks the Justice Department has hinted at wide-ranging investigations, and the Commodity Futures Trading Commission, CFTC, has announced actions taken against traders who conspired to raise oil prices. As we know, there is a long history of price manipulation in the metals market. Readers will recall the Hunt brothers' attempt to corner the silver market. And the volumes on the markets are small enough that it is possible to hide any inventory sufficient to force prices up, a point even financial columnist Paul Krugman admits, although he prefers the supply and demand story. Finally, the most popular explanation is the nation's capital today is that financial speculation. Finally, the most popular explanation in the nation's capital today is that financial speculation in commodity futures markets is the real culprit. Both the Senate and the House have held hearings into this issue, with impassioned testimony presented on both sides. So far, most of the discussion has centered around oil prices, with airlines, truckers, and other users of fuel blaming speculators, while financial market representatives, as well as most economists, reject these claims as naive. However, the boom in commodity prices is broad-based, so any analysis must go beyond oil. I will argue that all three explanations are plausible, and the identified mechanisms mutually reinforcing. However, it appears quite likely that the rise of investments in commodity indexes, a particular kind of speculation that has been called index speculation, is the most important cause. Further, commodities merely represent the latest asset class identified by money manager capitalism as ripe for financialization. On the one hand, this means that the problem is mostly human-made. Rising energy and food prices do not result, for the most part, from any natural shortages. It would thus appear relatively easy to reverse price trends. On the other hand, it means that the problem is systemic. It results from the operation of the type of capitalism we have inherited. Only fundamental changes to the structure of our economic system can break the cycle of boom and bust, and halt the continual search for new asset classes. It won't be easy, but it isn't impossible. A final note. As this brief is being prepared for publication, commodity prices appear to have reversed course. While this provides welcome relief, it does not mean we are out of the woods yet. Falling commodity prices will generate problems. Production decisions as well as portfolio allocations have been made on the expectation of rising prices. A lot of leveraged money has gone into commodity markets, including physicals as well as futures. So just as falling real estate prices are devastating for households, for the real estate sector generally, and for financial markets, there will be significant fallout from the slump in commodity prices. Further, without fundamental reform, we can expect managed money to begin its search for yet another asset class to financialize. Just as managed money moved from equities to real estate and finally to commodities, a collapse of this market will push funds into yet another. Thus, a policy response is still necessary.